All right, today we're going to talk about the top investing commentary and some of our original articles and podcasts on the Validea Group Investor blog for the week of March 26, 2021. And to start, I'll just quickly give an overview of the article that I wrote. I titled it The 5 Horsemen of Valuation Ratios. As I started the article out with, I probably would have rather been writing about pro wrestling and Ric Flair and the 4 Horsemen, but I ended up talking about value ratios instead. So what I did in the article is I kind of looked at the more popular, I guess, valuation metrics that are used: price to book, PE, price to sales, price to cash flow, and enterprise value to EBITDA. And what I did for each one of those is I defined what the ratio, what the measure actually is looking at, what financial statement it comes from, whether it comes from the income statement, balance sheet, or cash flow statement, what the strengths and weaknesses of the ratio actually are that I could kind of either come up with myself or find. And then I tried to give an example of how each one was used in one or two strategies, just to give the reader some insight into how these ratios are utilized, at least in the models that we run. And then what I did is I went through all the different criteria, or all the different strategies, on Validea, and I tried to find what models used each ratio. So for example, like enterprise value to EBITDA, which is used in some of our newer models. I mean, that's used in the acquires multiple investor model we run based on the acquires multiple book. Jim O'Shaughnessy's value composite model, Patrick O'Shaughnessy's millennial investor model uses kind of part of enterprise value, and then a private equity investor model we run. So that's what I tried to do for each one of the ratios. It was really just to kind of, I think anyone that's interested in learning about what these actually are and how they're used, I think, I hope the article was useful. I actually got some pretty positive feedback on it. So that was the article.
This is also really important for people that do, by the way, that invest in funds too, not just investors like us who are, buying individual stocks, because, when you look at value ETFs or value funds, people tend to think, oh, they're all the same, they're all doing the same thing. But what you talked about in the article, these 5 major ratios, I mean, a fund that uses the price to book, which by the way is the most commonly used one in ETFs and probably the least effective over time, is very, very different than, one that uses price to cash flow or something, or one that uses a value composite or something like that. So, it's not just important from the perspective of understanding it if you're picking stocks, it's also important to understand it if you're buying funds, because you want to make sure you know what you're getting, because the returns of these, and we've sort of seen this coming off the bottom, the dispersions of these value funds can be huge. Something that uses one type of metric can have a very, very different return than something that uses a different metric.
Now, I don't think our podcast guests, which I'll let you talk about, would really like any of these ratios. So who do we have on the podcast this week?
Yeah, so we had Rafael Resendes from Applied Finance, but he would actually tell you to take all these and throw them in the garbage pretty much. But it was a really interesting interview, and it's important for us as believers in, quantitative value to talk to people who take the other side of that argument. And, the other side of that argument is basically that, these shortcut cheap ratios are not really getting at what a company is worth. They're not really getting at intrinsic value. And so that's what he did a really good job of explaining in the podcast. He talked to us about, some of the shortcomings of these systematic value ratios we use, but also how he would go about from the ground up looking at the intrinsic value of a company, how he looks at things like, for instance, economic margin, which is your cost of capital minus your return on capital minus your weighted average cost of capital. So the actual economic profit a company generates is something he looks at. And he tries to get at this difference between something that's cheap and something that's a value. And, those of us that are systematic investors, we use these shortcuts to try to, get at both of those things. But you could argue that, Google 5 years ago was very cheap, although it never actually was a value. And so he has a model that tries to, get at what companies are actually values. And, some of those companies will be cheap by standard metrics, but some of them will not be cheap.
Yeah, I thought it was a great interview. I mean, he's full of knowledge when it comes to this academic research and the testing period in terms of what's worked with price to book. And, he kind of showed a couple of charts where it really hasn't worked since it's been, out there and published. And then, this idea of intrinsic value, trying to find the economic margin in a company, and then trying to assess whether or not that company is, generating a positive return on the money it's investing back in the business, higher than the cost of capital. It's something that, really resonates with me. And his firm has been running this since 1995. So he kind of, drives home the point that the real test for any of these sort of systematic strategies is really the out of sample period. And they've been basically running, it seems to me, a model that's been very consistent over, a 25-year period. So it definitely was a good discussion. I hope you guys check it out.
Yeah, and we had John Montgomery on the podcast. He sort of had this idea that the only true out of sample is the future, and so we don't know. I mean, those of us that are systematic value investors might be right. Those that say systematic value investing doesn't work anymore might be right, and by the time we know that, it's going to be too late to some extent. So it's only the future will tell. But he has a very interesting way he's looking at this, and it's important for those of us that believe in systematic value to look at that other side and to look at a different way to look at things than we believe in.
All right, what was your article this week, Jack?
Yeah, so it was Dalio says it's time to buy amid stupid bond economics, and so this was interesting to me for a couple of reasons. One is because I agree with everything he said in here, which is something that everybody's been saying, which is bond yields are really low right now. So there's two problems for bond investors with that. One is I'm not getting much of a yield by investing in bonds, and two is they don't have that much room to go down. So this whole idea of bonds protecting me in a deflationary shock, that's not potentially as true right now as it has been in the past because yields just don't have that far to go down. So he made a case basically about how it is stupid to hold bonds, I think is the way he put it. But the flip side of this for me, and the reason I highlighted it is I always get worried when all of us agree on something like this. I always get worried that everybody thinks it's really dumb to hold bonds right now, because typically those things in the past have been situations where all of us end up being wrong. And so I'm constantly trying to think about this myself. How can all of us be wrong about bonds? And part of it is we don't necessarily, if you do get another major decline in the market, you don't necessarily need bonds to have huge positive returns for them to add value to you. Even if they don't go down a lot, or if they go up a little bit, they're adding value relative to stocks. So that might be one of the reasons we're getting it wrong. And the other reason I think we might be getting it wrong is Morgan Housel's talked about this in interviews, is the idea that bonds exist as a reason to prevent you from selling your stocks. And so, if you had 100% in your stocks and we go get a 20% decline, people might abandon their stocks. Whereas if they have bonds, that may, the fact that smoothing effect on their overall portfolio may allow you to hold on to your stocks, which are the true things that are going to generate your return over time. So it's just interesting to me. Number one, I agree with Dalio. I think now is probably not a good time to be investing in bonds, but I also think it's important for all of us to sort of look at the other side of that and say, how could all of us be wrong? Because when the conventional wisdom is like 100% in one direction, a lot of times it won't be right.
Yeah, I think that's the standard narrative right now. It's like you don't want to be holding bonds because interest rates are going up and you're going to lose money. But, Dalio, clearly Bridgewater is one of the most successful hedge funds ever in the world. They manage, however much money, and Dalio is such a thoughtful guy that knows so much about market history and sort of these, I guess, periods in the market, and he tries to kind of relate them to sort of where we are. It's just I sometimes feel like it's a little bit glasses half empty with his view on things, I find, and I don't know if I go back and think about like his things he's been expressing over the last couple of years. I don't necessarily know if he's been more on the right side of things, but it doesn't mean that he won't be with this one. And sometimes guys like this, they come out and they're really early on their view. Eventually they'll be right, and maybe be right by a lot. So it'll be interesting. The other thing that he kind of said in that article, I don't know if you picked up on this, but that he kind of favors, or he said, I also believe that the assets in the mature, developed, reserve currency countries will underperform the Asian, including Chinese, emerging country markets. So he's kind of seems like to be a little bit more bullish on currencies of emerging countries, including China versus the U.S. So we'll see about that.
Yeah, you made a really important point there, which is we all tend to see these articles, Dalio says this or Druckenmiller says this. And the reality is, for those of us that are individual investors, we should pretty much discard all of that. If Buffett's out there saying, preaching long-term, low-cost investing, you can listen to that. But if there's any sort of short-term, projections from any of these, billionaires, they exist in a totally different world than we exist in. So there's this tendency to want to listen to what they're saying. And, he may be very well right about this, but, it's always important to take that with a grain of salt and say, my situation is very different than Ray Dalio's situation. So maybe I don't want to necessarily listen to his advice. What was your article this week?
Yeah, so the article that kind of caught my eye was this article in Fortune. 13 years after investing in an obscure Chinese automaker, Warren Buffett's BYD, I think it's Baidu, not Baidu, but BYD, I guess you call it. That's the name of the company, that is paying off big. And so basically, it just goes through investment that Buffett made 13 years ago, $232 million in a relatively small, unknown Chinese car company. Again, it's BYD, not Baidu. I misspoke there. And at this point, as of the end of 2020, in Buffett's shareholder letter, it talked about how that $230 million investment is now worth basically $5.9 billion, and BYD has become the 8th largest position in Berkshire Hathaway based on market value. It just kind of talks about how this company is actually selling cars. They sold 130,000 electric passenger vehicles last year. So it's kind of competing, with sort of some of the bigger firms over there, including Tesla, in terms of penetrating the Chinese market, which is, obviously huge. And I think it's just more about kind of what I think I thought of too here is how Buffett, over the years, and this is something we've talked about, this was a relatively small investment at the time. But how Buffett has pivoted and gotten into some of these more technologically advanced companies. I think this was at the advice of Munger, who was really bullish on the founder of this company. Somebody said, it says this guy's a combination of Thomas Edison and Jack Welch, something like Edison in solving technical problems and something like Welch in getting done what he needs to do. And that's what Munger said of this, the CEO and the founder of this company, Wang. So anyways, it's just, Buffett's clearly benefiting from the performance of this stock. And it's just interesting. It's kind of outside his normal wheelhouse, but so far so good.
Yeah, to your point, it's interesting to see Buffett, how much he's evolved over the years. I mean, starting at cigar butt Graham investor, and then going to, buy high quality companies, but try to buy them as cheaply as possible. And then going to Apple, which is a technology company, but, a major developed technology company. And then you're getting into things like Snowflake and obscure Chinese automaker, which is what they call it in this title. So it's just interesting. I mean, he's come, and a part of this is he has new influences on him, but it is interesting. He has evolved his strategy a lot over the years from where he started.
Great. So we'll put links to all this stuff in our show notes in the article, and we appreciate it. We'll see you next time.
Thank you.
If you'd like to keep up on the research, writing, and curation we're doing at Validea, please go to blog.validea.com to learn more and stay updated. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJCarbonneau. Thanks so much.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.